A lot of questions here. Is this a bailout? What would you call this at this point for SVB?
Well, I think the whole SVB thing is about a circumstance that is clearly a bailout, right? The government is expanding capability, it's protecting depositors. They've chosen not to protect bondholders or shareholders at the moment. There's questions of equity there actually, but yes, it's definitely a bailout to use that word. But our worry is again pretty simple. The Federal Reserve has been both fighting inflation, and now it has to fight a banking crisis brought on by its own hands. As my favorite analogy is this week, they're both the pyromaniac and the firefighter. And that's a pretty precarious position for the Fed to be in. If they back off on inflation and we get a rebound in inflation, which we don't believe, by the way, that could put them in a really difficult circumstance. So what we're really seeing is fallout from an aggressive Fed campaign to tamp down inflation globally.
And we knew that Credit Suisse was already under pressure even before this. We saw the rumblings in the background. Its failed acquisition of First Boston Corp, that didn't pan out for them very well. And also a number of scandals as well. But now, of course, its top shareholder ruling out that it's going to be backing them, providing more assistance at this point. How much of this is just bad timing versus something more systemic that we should be keeping an eye on?
Certainly bad timing, but that doesn't mean it's not systemic. I think for 12 or 14 years since the global financial crisis, cash and monetary conditions have been super easy. Every bank feels comfortable when deposits are flowing in, when cash is available, when interest rates are low. What we're seeing now is, of course, the impact of the reversing of that strategy. Tight money, higher interest rates. And so, sure, Credit Suisse is a specific thing. And by the way, the chairman of the Saudi bank isn't exactly JP Morgan, right? Walking the streets and saying, we're going to start to buy today. He's doing the opposite thing and setting off the markets this morning. But, this is, again, a fallout of a new regime in monetary policy. And we've been fairly cautiously positioned in our portfolios, not knowing what would break, but knowing something probably would. And certainly something has. We'll see how the Fed fights it. I think the 2-year Treasury note is really the important number here, and we've seen that fall from 5% to where it is today, 3.70 or something like that, in a matter of days. A breathtaking drop in yields in the short term, and that's just saying that the Fed's going to have to lower rates before they raise them.
And you mentioned this idea of really sort of seeing some of the writing on the wall as interest rates started to rise, especially when you look at the SVB story. I mean, they invested in high quality bonds, kept them on their balance sheet, pretty standard practice. But when we did start to see interest rates rise, what were some of the missteps or things that could have been handled better, if anything, to try and prevent this situation?
Well, it is hard to play the blame game quite yet. There's plenty of blame to go around. I think systematically, the Federal Reserve has raised rates incredibly quickly. And they have to know that's going to create some distress and stress in various parts of the financial markets. That clearly has been seen now. In terms of SVB and other banks in their circumstance, or at least similar, could they have done a better job of hedging some of that interest rate risk and that duration risk? Absolutely. Not being with a chief risk officer for an incredibly important period of time when rates are going up, I think must have contributed. I don't know. I wasn't in the room, but basic missed worries about the exact outcome. And then, of course, having the CEO selling shares literally weeks before this doesn't look good either. So, there's clearly some challenges there. The shareholders are going to be left to pick up the pieces. I think the markets right now are playing the next game, right? Who's going to be next? We see First Republic struggling in a significant way. There's others that are as well. Again, this comes back to a very, very simple proposition. When the Federal Reserve takes rates from 0 to 4 3/4 in the course of a year, things are going to be stressful, and we're seeing that stress play out.
And you mentioned First Republic there. They did get at least some infusion of liquidity from the FDIC and from JP Morgan as well. Obviously, a different situation from the backstop that we saw with SVB. How much contagion are you expecting here? A lot of people saying perhaps it's more contained. Others saying this is a canary in the coal mine circa 2008. Where do you lie with this?
It's certainly, I'm not sure we know yet. And people who say they know, I think, are jumping the gun. If the Fed's actions on Sunday evening, and look, there was a huge, group of people working all weekend to understand the impacts of what happened at SVB, and I think the Fed and the U.S. Treasury's moves on Sunday evening really did a lot to calm the nerves and to stem some of the tide. The problem is going to be now. This becomes a psychological game of, again, gotcha. Who's next? Where should the shorts come in? Who's spreading rumors on social media? How quickly are people taking money out of their banks with their cell phones? Right? You don't have to go line up at your local bank anymore. This isn't a wonder. It's a wonderful life. This is, you can move money instantaneously as a client and as a customer of a bank. So all of those things are new, and they change the dynamics of what we're trying to understand. And so it is really hard to know with precision and foresight whether or not this is just simply the first step in a problem or not. What we do know is that lots of banks have bonds that are underwater on their balance sheet, right? That we know, and I'm not sure people were focused on it before this, but clearly with folks like First Republic and the other banks that are struggling, and some of the financial services companies in general. We're gonna see more signs of stress, which is why understanding whether the Fed's going to continue to raise rates or actually cut rates now will be the next big the big tell, I think, of where we're headed.
Certainly extra pressure going into that FOMC meeting this month. A big thank you there to Michael Vogelzang, CAPTRUST CIO. Thank you for your time this morning.